Hi traders! In this video, we will talk about market rollover. Market rollover in Forex means extending an open position to the next trading day. When you do this, it can cost you or make you money. It all depends on the interest rates of the currency you are trading. Rollover happens every day at 5 p.m. Eastern Standard Time. If you have a buy position and the currency you're trading has a higher interest rate than the other currency, you will make some money. If the other way around, you might have to pay some interest. This also applies if you have a sell position. Now, what could go wrong for you as a trader? Here are some things to watch out for. Price gaps. Sometimes, when markets are closed, unexpected events can cause price to jump when they reopen. These jumps can lead to losses if they go against your position. Lack of control. You can't do much with your trades when markets are closed. You will have to wait for them to reopen again to make changes. Increased volatility. Market open and close can have higher volatility due to lack of liquidity. This can lead to wider spreads and affect execution when market reopens. Overnight news risk. Stuff that happens when markets are closed can change how people feel about trading, and that can change prices. So, if you keep your positions overnight, you might have to deal with unexpected news that could hurt your trades. Lastly, cost of rollover. Keeping your positions through rollover can mean you have to deal with interest rate differences. This could either cost you money or make you money, depending on how your trades are set up. If you have any more questions or need further information, feel free to reach out. Happy trading!